You got to be careful of these economic sites because I think maybe they're written by AI or artificial stupidity. You can't really trust anything anymore that you see. I don't even know how I'm making these silver reports. I could be AI. Who knows? The land of Arcadia, my friends. 'Cause we'll keep on stacking till the end. Game. No time for fiat, 'cause we are Arcade. Here you go, Ben. Watch over us. Keep printing. Well, hello there, my friends. Rafi here from the End Game Investor with this week's Silver Report for Arcadia Economics. And there's so much going on, I don't even know what to say. So let's just get into the preview of the slides, and I will read the titles and whatever else it is that I do on the show before we get into the depth of it. So we got some short covering in GLD, about 500,000 ounces, 500,000 ounces short covering in GLD shares, specifically not in the futures market, but in the ETF. And I will show you how I know this. Silver premiums are finally down to pre-silver squeeze levels, or not exactly pre-silver squeeze levels, but normal levels that do not indicate any specific demand for physical silver by stackers or any stress in the physical markets, which indicates to me that the stackers are asleep at the wheel and nobody is believing this rally. They do not trust it, which means there is a lot of room to go on here. The proverbial wall of worry, the silver wall of worry in this case. We are at a critical level of open interest in gold for the hedge funds. The managed money longs and the COT reports are at the bullish bearish line going back to 2008, which means if we can sustain this level of open interest in managed money longs and hedge funds longs, that means probably we are in the beginning of a sustained bull market in gold. And of course, silver will follow, though it will lag in time. It will overtake gold in the end at the end of the run. It's going to go quickly, as it always does. We're going to take a look at cocoa because there is a major short squeeze in cocoa as a preview of what will happen in the gold and silver market. And of course, when there is a short squeeze, a real short squeeze in gold and silver, that means the dollar is dying in its last throes. Yen, in deep unchi. I looked up unchi. It means excrement in Japanese. I'm not sure if I'm pronouncing that correctly or if I'm using the correct idiomatic term or whatever it is. We're going to explain why higher interest rates in Japan, as the Bank of Japan just raised interest rates for the first time since 2007, why higher interest rates from a mechanical perspective, from a central bank balance sheet perspective, higher rates in this sense means a lower currency, which means higher consumer prices, what the Keynesians call inflation, but really is just the effect of inflation. I'm going to show you a serious mistake made by trading economics that you got to watch out for, because it's not just that they're trying to confuse you. I really think some of them are that stupid and they should really fix this mistake before they look really, really dumb. And we may think that the gold rally has started, but really, if we look at gold relative to other commodities, it has not. We are at levels that we were at the end of the bear market in 2015. This is just a commodity rally across the board. Wait until there's a gold and silver rally specifically, and then we'll see gold and silver really take off relative to other commodities, which we have not seen yet. And finally, mining stocks are in a perfect triangle going back to 2016, and that triangle is going to break out, and I believe it will be to the upside. And speaking of mining stocks, this silver report is sponsored by FSM, Fortuna Silver Mines. In the recent report released by Fortuna on March 11, 2024, they detail their new discoveries at the Séguéla mine and the Diambasou gold project. I wanted to highlight this one over here. I want to go into this specific deposit here, the Kula deposit. The numbers are huge. Results such as 22.5 grams per ton gold over an estimated true width of 9.8 meters from 208 meters downhole, including 68 grams per ton gold over an estimated true width of 2.1 meters from 215 meters downhole in drill hole SGRD 1783. This basically means that there's a lot of gold that has not been discovered yet, and the drill holes that they make will increase their reserves. Fortuna is in a good spot, especially considering that the gold to Huey ratio has reached a high, meaning gold stocks and silver stocks have reached a triple top low relative to gold. And I believe that ratio will head down starting now. And we're going to see gold and silver stocks really start to outperform. And yes, they've been horrible. And yes, we've been saying this for a while, but it doesn't change the fact that eventually it's going to happen as the dollar dies. And yes, I am long FSM, and do your own due diligence. And let's continue with this week's Silver Report with Ben just over my shoulder. So first slide here, we have some short covering in GLD on March 17th. I'll use these charts to explain how I see that, how I know that. I don't know it for sure, but it really looks that way, and I'll explain to you why I think it looks that way. So we have here a chart of gold shares, GLD shares. This is not futures. This is the ETF, specifically GLD, no other ETFs. This is only GLD. So we have the total metal in the trust, and we have a huge influx of gold here, about 500,000 ounces. This is from the day after. This is 0.05 million, so that's 50,000 ounces, but the day before was 500,000 ounces. This blue line here going up, and the gold stocks increasing in the ETF. So we see here that a lot of gold went in, but what do we see on the next chart? So that is transparent gold holdings, total transparent gold holdings in all gold funds across the board that we know about. On that same day, March 17th, this circle here, we see the bar was about 450,000 ounces or so. So all of maybe 430, it's hard to eyeball it. It's whatever, it's less than 500,000. So we had 500,000 ounces in on GLD, but only 450,000 ounces in on the same day across all gold funds, including GLD. So that means all the other funds, including the ETFs, including COMEX, including all the paper funds, unallocated, allocated, whatever, taking that all into account, gold only flowed into these funds to the tune of 450, 440,000 ounces. If you take away GLD, gold holdings were down about 50,000 ounces, excluding GLD, which means the only one that flowed in was GLD. It looks to me that there was a whole big short position in GLD that was being covered, and when you cover a short position in GLD, you have to put gold back in, especially if you are doing it in a basket size, which you would if it's 500,000 ounces. If this were retail demand in gold funds, we would have seen other ETFs and other gold funds increase holdings. We did not see that, so I assume this is short covering. If it's short covering at a loss because GLD is at an all-time high. Premiums finally down to normal levels. It's a discouraging sign, but it's also an encouraging sign because it means that there's a lot of fuel left to fuel this market because the stackers are not participating in this yet. So I have here the red line of where premiums have been historically. This is where we are now, 10.67%. This is junk silver coins. And we have here, this is the same premiums we were at during the 2014, 2015 near bear market bottom in the silver market. And it was the same around here in 2021, just around when silver squeeze started, but before it started to really take off. If you can hear my chickens in the background, I'm sorry, I think they're laying an egg.
You son of a...
And this is interesting here. We have a history of managed money longs. This is the COT charts. I put a bunch of rectangles here. I'll explain in a second. So we have here on the top here the gold price in US dollars. And on the bottom, we have gold, COMEX gold futures managed money long positions minus COMEX gold futures managed money short positions. So basically the net position, the net long position, net long or short position by the managed money, by the hedge funds. So we see here these rectangles, okay? This is where we are now, 141,000 contracts. This is historically high. It's high, but it's not historically high. And we see here in the first rectangle, we were consistently above this level here, just above this level. And this was like the support level for open interest in the managed money. So this is basically how much hedge funds are long gold, how much they're speculating. So we saw here from about 2009 to 2011, during the gold top in 2011, we were consistently above this number, which meant a persistent bull market. This was a huge gold rally. And here at the top here in 2012, when the bear market really started, we just got up to the level, but we didn't quite break it. And now here we see the bear market. We were consistently below this level in open interest for the managed money longs, for the hedge fund speculative long positions. And we could not break that. We tested it right here, but we kept falling in the gold price. And silver is also obviously reflects gold here. And we see here, we broke through it once here, and we broke through it once here in this level, in this little intermediate top here. And we've been below that level in open interest since 2020, since the gold top in 2020, right? Gold top in 2020, we were above it. And now we've been below it for the last 4 years, but we're touching it again. This is the third test of the managed money long net positions. Are we going to break through it? If there's going to be a speculative fervor in gold, especially in the futures market, we will. And we could see the same conditions we saw here from 2009 to about 2011 in the gold top, September 2011. And we should see a very similar price action to what we saw in 2009, 2011, but I think it's going to be more extreme because the dollar is in a much more precarious position than it was back then. I want to go into cocoa for a second, not because cocoa is related to gold directly in any way or silver, but because it shows you what a short squeeze in the futures market really looks like. Okay, so we have here, this is an all-time high in cocoa. Forget about the market reasons why it's happening. I don't know much about cocoa markets, but I'm assuming there's a shortage in cocoa or something. So we have here the sign, please don't do cocoa in the bathroom. Somebody sent that to me on WhatsApp, so I figured I'd share it here. It's very, very relevant. And we see here, this is the managed money long positions here. They're also speculating long on cocoa. So we were at an all-time high here. The hedge funds don't always get it wrong. They got it right here. We were at a high here. I'm not sure if it was an all-time high. I didn't look at the charts, but it was a high, definitely a local high of about 80,000 contracts. And now they've been covering, or they've been selling into this rally. And the producers down here, we have in the red. I checked that to make sure this was red with my wife, who is not colorblind, but I can't really tell the difference. But I'm assuming she's not trying to make me look like a fool here. So let's just hope she's right and that she's not trying to make me look stupid. So 46,500 contracts short. And the producers have been covering their short positions since this short squeeze started. So it's the producers of cocoa that are in a short squeeze. Right? This was very reminiscent to what happened in the nickel market March 7th, 2022, when this huge nickel mine company was short nickel and there was a short squeeze. So even though it was a nickel mine, it was going bankrupt because they had margin calls on their short positions. I suspect the same thing is happening to cocoa producers now. They're in trouble and they got to cover their shorts here and they're hedging. It's dangerous to be short to hedge in these environments when the dollar is dying because it will kill your finances no matter who you are. But you can't not hedge, but you can't. It's an impossible situation for producers of anything, especially when all the derivative markets are going to explode. So this is basically what we see as a short squeeze. The COT is narrow and the price goes up. We're not seeing that in gold yet. We will eventually, and that will be the signal of dollar death. The yen. I wanted to go into the yen here. So the yen is falling again, and I've been saying this again and again. The yen is going to fall as interest rates rise because the yen is the Japanese bond market, because the Bank of Japan has acquired about half of the Japanese government bond market. So if the yen is the liability and the bond is the assets, they are the same thing. And as the bonds go down, the yen goes down. So raising interest rates in this mechanical sense is going to increase prices because the yen will fall in dollar terms as interest rates rise, as we just saw when they rose interest rates and the yen collapsed to a triple top here. And a top means a low because it's 151 per dollar. So the higher this number is, the lower the yen is, and we're at near 1990 support, which I believe is 158. Once we break through that, we're basically in space here, and the yen could totally collapse. I just wanted to show here that 46% of the yen is in government bonds. So we have here the Japanese government securities on the Bank of Japan balance sheet. So let's just say 600 flagrillion here, whatever that number is. This is a unit in thousands of yen. So I think this is a 600 trillion, and the Japanese national debt is I think 1,300 trillion, so that's 1.3 quadrillion yen. These are all normal numbers. Don't freak out about them, and whatever. Yeah, that's inflation. So this is why I just wanted to show how the yen moves with bonds, meaning if bonds go down, the yen goes down. If bonds go up, the yen goes up. So the blue line is the 10-year yield. As this blue line goes up, that means that bonds are going down. Right? If bonds are going down, this line goes up, means the yen is going down. The higher this number is for the red line or the green line or whatever color that is, the lower the yen is. And we can see these things basically move in tandem because the yen is the Japanese government bond market. That's what happens when you buy too much debt. Money is debt. It is that way. It doesn't start that way, but as the fiat system decays and progresses, money and debt become identical. Now, this is I don't understand how trading economics can make this mistake. This is a page from the yen page of tradingeconomics.com. I don't understand how they made this or why it's still there. I just checked it this morning. This mistake is still there. So this is the yen again here. As the higher it goes, the weaker the yen is, right? If it takes 140 yen per dollar, the yen is stronger than if it takes 151 yen per dollar. And they say here the Japanese yen strengthened past 151 per dollar, rebounding from 4-month lows as the dollar weakened after the U.S. Federal Reserve reiterated expectation for 3 interest rate cuts. What the hell are they talking about?
What the are you talking about?
What the are you here?
What the
are you talking about?
What the are you talking about?
This means a weaker yen, not a stronger one. You got to be careful of these economic sites because I think maybe they're written by AI or artificial stupidity. You can't really trust anything anymore that you see. I don't even know how I'm making these silver reports. I could be AI. Who knows? So I just wanted to go over this chart. This is the gold relative to the CRB index. Look at this. So everybody thinks we're in a gold rally. Oh, not really. We're in a commodity rally. This is a commodity across the board rally because if it was a gold rally specifically, gold would be outperforming commodities, but it isn't. This is the gold to commodity ratio. So we see we're at the same number here as we were in 2023, the same number we were here in 2020, just prior to the all-time high when oil went to like negative $35 a barrel. And we're at the same numbers here as we were in early 2016 when the bear market ended. So no, we're not in a gold rally yet. In dollar terms, yes, but in commodity terms, no. Just wait until we're in a gold rally in commodity terms and dollar terms. That will mean the dollar is dying. And mining stocks, going back to Fortuna Silver Mines, our sponsor, FSM, for this week's silver report. Mining stocks are in a perfect triangle that looks about to blow out or break higher. The higher this is, the higher that gold stocks are relative to the gold price. We've been in an ascending triangle since the bear market bottom at the end of 2015 here. We're going to break out of this triangle right now. I don't know for sure if it's going to be right now, but we're testing it again here for the 1, 2, 3, the fourth time here since 2020. It's going to break out. It's going to break out to the upside. And when it does, gold and silver stocks are going to zoom. And this is not advice. And so there you have it, this week's silver report for Arcadia Economics, featuring Ben Bernanke in silver over my shoulder, watching as a monetary angel, throwing me helicopter money. Throw it all out. Now it's your grandchild in charge of the Fed, your ideological grandson, Powell after Yellen, after you, and Greenspan. Is he still alive? I don't know, what is it with these people?
To most people, this is just an ordinary fetus. But to people like me, it's hope.
Anyway, this is Rafi from the Endgame Investor with this week's silver report for Arcadia Economics. Please subscribe to the Endgame Investor at endgameinvestor.substack.com. I got a very interesting speech that I gave in Petah Tikva in Israel on the endgame, on money, on the Misesian regression principle, and why the elites will not take over the world, because in the end we will stack the real money and they will be bankrupt, or at least they will not have the ability to inflate the currency anymore, and they will have to spend their real money, which is much better than inflating from us. So sign up there at endgameinvestor.substack.com and check out the text of my speech this week on Monday in Israel. This is Rafi, the Endgame Investor, with this week's silver report for Arcadia Economics, and I'll see you guys next week.